So the topic that we're going to discuss is about interim financial reporting, which is under PAS 34. So for the introduction, PAS 34 stated four of the essential statements with regards to interim financial report. First one, PAS 34 prescribes the minimum content of an interim financial report and the recognition and measurement principles in complete or condensed financial statements for an interim period. So the minimum content contains of a set of condensed financial statements for the current period and comparative prior period information, such as statement of financial position, statement of comprehensive income, statement of cash flows, statement of changes in equity, and selected explanatory notes. The second statement is that PAS 34 does not mandate which entities should produce interim financial reports. So PAS 34 does not command which entity is required to make an interim financial report. Moreover, PAS 34 is applied when an entity chooses or is required by the government or other institution to publish interim financial report that complies with PFRS. This is self-explanatory because, as mentioned in the statement, we can only tell that PAS 34 is applied if the entity makes an interim financial report that conforms with PFRS, and also if any of institution or government required to publish a certain report. Lastly, PAS 34, however, encourages publicly listed entities to provide at least a semi-annual financial report for the first half of the year to be issued not later than 60 days after the end of the interim period. So what is an interim financial report? An interim financial report is a financial report prepared for an interim period and contains either a complete set of financial statements as described in PAS 1 or a set of condensed financial statements under PAS 34. Additionally, interim reports are intended to provide an update. So what is an interim period? An interim period is a financial reporting period that is shorter than a full financial year. It is also considered to be the standard monthly time period that most organizations or entities use for their financial reporting. So, in presenting an interim financial report, the entity has two options. Either it chooses to apply the standard PAS 1 or PAS 34. If the entity's main purpose is to provide complete set of financial statements in its interim financial report, then it should apply PAS 1. On the other hand, PAS 34 will be applied if the interim financial report being provided contains a condensed set of financial statements. Here are the list of complete set of financial statements under PAS 1 and condensed set of financial statements under PAS 34. So most of the content of these two sets of financial statements are the same except for the term condensed or more precise statement under the condensed set. Moreover, complete set has an additional statement of financial position which is absent in condensed set. Here are other additional concepts in interim financial report. First one is relevance over reliability. It is understandable that interim report is produced to provide an updates to financial statements of an entity. Thus, this concept clearly reminds us that only those relevant information or event is needed with making an interim financial report. The second concept is materiality in estimates, wherein in making an interim report, most of the time, estimates is usually used because some of the data or events are being forecasted, meaning we have to abruptly put an estimated value yet reliable. Lastly, note disclosures or those selected explanatory notes provided in interim financial reports should not be repeated in the process of making financial statements. The following are the significant events and transactions relevant in making an interim report. Since entities focus on giving information with regards to significant events that happened since the latest annual period, this list of events requires disclosures if they are deemed significant. Disclosures are statements provided by a company, business, or corporation that identifies the financial strategies that are being used and reveals things like costs and profits for a certain calendar period. Thus, disclosure is a significant element in interim financial report. These are common events and transactions that are disclosed in the interim financial report. There are two periods for which an interim financial statements are presented. Report can be presented in semi-annual or quarterly period. In semi-annual period, the interim report is made half of the year. In this period, entity prepares for a calendar year which starts on January 1 and ends in December 31. So the end of the 6 months is June 30 and another end of 6 months is December 31. On the other hand, most of the time in making an interim financial report, the quarterly period is being used. Of course, if this period will be chosen, then at the end of every 3 months will be the date of publishing interim financial report. Materiality are assessed in relation to the interim period financial data and not forecasted annual data. PAS 34 recognizes that interim measurements may rely on estimates to a greater extent than measurements of annual financial data. In recognizing, measuring, classifying, or disclosing an item for interim financial report, materiality of data must be given more importance than forecast annual data or those information that have been evaluated over a 12-month time period. With regards to views on interim reporting, there are two views being applied. The first one is the integral view, in which interim period is considered as an integral or relevant part of the annual accounting period. Under the integral view, revenue and expenses for interim periods are based on estimates of total annual revenues and expenses. On the other hand, discrete view is where the interim period is considered as a discrete or standalone accounting period. This view defines that earnings for each period are not affected by projections of the annual results. Moreover, these are additional accounting principles provided by PAS 34. Firstly, losses from inventory write-down, restructurings, or impairments in an interim period are accounted for in the same way as in annual financial statements. So if there are future changes in estimates, the original estimate is adjusted by increasing the additional loss or by transposing a previously recognized loss. Secondly, a cost that does not qualify as an asset in an interim period is not deferred, either to wait if it qualifies in the next period or to smooth earnings over the interim periods within a financial year. Same as in liabilities at the end of an interim period, liabilities must meet all the recognition criteria at that date, otherwise they are both recognized in the interim report. Lastly, income tax expenses in interim periods are based on the best estimate of the weighted average annual income tax rate expected for the full financial year. An average tax rate is computed by adding all sources of taxable income divided by the total amount of tax. Measurements in the interim period are made on a year-to-date basis so that the frequency of reporting, whether it is annual, semi-annual, or quarterly, does not affect the measurement of annual results. This means that recognition of income, expense, assets, or liabilities in the financial statements should not be deferred or anticipated merely because of preparation of financial statements for an interim period. So for the recognition and measurement, for gains and losses, if there are any of them that arise in interim periods, such as inventory write-down and reversals, asset impairment, discontinued operations, and fair value changes in assets measured at fair value, instead of being deferred, they are recognized immediately because they are part of statement of comprehensive income under profit or loss. Next is recognition of costs and expenses. If income provides benefit for an entire year or incurred over the year, they are spread out over the interim periods. For example, depreciation, amortization, insurance expense, and interest expense or income. Discretionary income or optional income are immediately recognized in the period the income is earned, such as dividend income. Lastly, income tax expense in the interim periods, which is computed using the best estimate of the weighted average annual income tax rate expected for the full financial year. Revenues received seasonally, cyclically, or occasionally are not anticipated or deferred in the interim period if anticipation or deferral is also not appropriate at the end of the annual period. This only means that these revenues will be recognized the moment they occur. Costs incurred unevenly during the financial year are anticipated or deferred in the interim period only if it is also appropriate to anticipate or defer them at the end of the financial year. It means that costs which have been incurred as long as costs are incurred inside the interim period, which are appropriate to anticipate or postpone, are deferred for interim reporting purposes only. We have the illustration 1, which tackles about the recognition and measurement in interim periods. So here's the solution for the computation of the adjusted profit before tax. The first thing we have to do is to less the write-down of inventory with a total of 20,000 pesos to 1 million unadjusted profit before tax. Same as with the impairment of asset, which is a total of 40,000, will also be deducted on the 1 million unadjusted profit before tax. Unrealized gain, on the other hand, with a total of 5,000 will be added because investment in FVPL is treated as gain. Depreciation of 360,000 will be multiplied by 1/4 because there is no depreciation recognized during the second quarter, thus only first quarter will be counted. The total of depreciation, which is 90,000, will also be deducted. Lastly, employee benefits that cost 240,000 will be computed the same as in total of depreciation, so 60,000 will also be deducted to the unadjusted profit before tax. So now, we have 795,000 pesos adjusted profit before tax.
Here's an illustration for costs incurred unevenly. Requirement is to compute for the profit or loss for the first quarter ended on March 31. Year 1. Sales of 1 million, cost of sales of negative 450,000, and would result to gross income of 550,000. Commission of negative 50,000, bad debts of negative 10,000, depreciation of negative 60,000, insurance of negative 10,000, property tax of negative 6,500, advertising costs of negative 50,000, staff bonuses of negative 23,000, less on sale of negative 30,000, repairs of negative 12,000, rent of negative 17,000, and other operating expenses of 120,000. It would result to profit before bonus to key personnel of 161,500. Bonus to key personnel, negative 16,150, and the profit for the first quarter would be 143,350. Note that items N and O in the illustration above shall be recognized only when actually incurred. Another example for costs incurred unevenly. The requirement is to compute for the adjusted profit before tax for the first and second quarters. An adjusted profit before tax of 880,000 for first quarter and 920,000 for second quarter. Unfavorable variance of negative 24,000 for first quarter, and there is no unfavorable variance for second quarter. There is no advertisement cost for the first quarter and negative 30,000 for the second quarter. Unrealized loss on investment of 100,000 for first quarter and unrealized gain on investment of 120,000 for the second quarter. Research and development expense of negative 10,000 for the first quarter and negative 12,000 for the second quarter. Foreign exchange loss of 10,000 for the first quarter and foreign exchange gain of 15,000 for the second quarter. Impairment loss of negative 8,000 for the first quarter, and there is no impairment loss for the second quarter. Adjusted profit before tax for the first quarter would be 728,000 and 1,013,000 for the second quarter. Here is an illustration for provisions, changes in estimates. The requirement is what are the effects of the transactions listed above on profit or loss before tax in the first and second quarter interim financial statements of ABC Company. Inventory write-down of negative 10,000 for the first quarter, reversal of write-down of 100,000 for the second quarter, warranty expense of negative 50,000 for the first quarter, and negative 170,000 for the second quarter. Bad debt expense of negative 20,000 for the first quarter and negative 14,000 for the second quarter. The net effect on profit or loss would be negative 170,000 for the first quarter and negative 84,000 for the second quarter. Here is an illustration for measurement of interim income tax expense. The requirement is to compute for A, the weighted average annual income tax rate, and B, income tax expense recognized in the quarterly interim financial statements. Solution for the requirement A. Pre-tax profit of 200,000 from the first 200,000 pesos multiplied by 20%, the income tax expense on the first 200,000 pesos profit would be 40,000. Pre-tax profit of 200,000 multiplied by 30%, the income tax expense on additional earnings would be 60,000. Total income tax expense for the year, 100,000 divided by the total profit for the year of 400,000. The weighted average annual income tax rate would be 25%. For the requirement B, quarterly income tax expense. The quarterly income tax expense are computed as follows. Another example for the measurement of interim income tax expense. The requirement is to compute for A, the weighted average annual income tax rate, and B, income tax expense recognized in the quarterly interim financial statements. Requirement A, total profit for the first 3 quarters, 35,000, multiplied by 30%. The income tax expense for the first 3 quarters would be 10,500. Profit for the last quarter, 15,000 multiplied by 40%, the income tax expense for the last quarter would be 6,000. Total income tax expense for the year would be 16,500 divided by the total profit for the year of 50,000. The weighted average annual income tax is 30%. For the requirement B, quarterly income tax expense. The quarterly income tax expense are computed as follows. Here is an illustration for income tax benefit. The requirement is to compute for the income tax expense or benefit recognized in the quarterly interim financial statements. Solution: quarterly income tax expenses or benefits are computed as follows. Pre-tax profit loss of negative 15,000 for each quarter, and average tax rate of 30% for each quarter. The tax expense or benefit for the first and second quarter is negative 4,500, and the tax expense or benefit for the third and fourth quarter is 4,500. Here is an illustration for tax year and financial year do not coincide. The requirement is to compute for the income tax expense recognized in the quarterly interim financial statements. The quarterly income tax expenses or benefits are computed as follows. Next is an illustration for net operating loss carry forward. The requirement is to compute for the income tax expense recognized in the quarterly interim financial statements. Solution: total profit for the year of 40,000, net operating loss carry forward of negative 10,000, that would result to taxable profit of 30,000, multiplied by the income tax rate of 40%, that would result to income tax expense for the year of 12,000, divided by the total profit for the year of 40,000. The adjusted weighted average annual income tax rate would be 30%. The quarterly income tax expenses are computed as follows. Another example for net operating loss carry forward. The requirement is to compute for the income tax expense recognized in the quarterly interim financial statements. The total profit for the year is 50,000. Net operating loss carry forward of negative 20,000. The taxable profit would be 30,000 multiplied by income tax rate of 40%. The income tax expense for the year would be 12,000 divided by the total profit for the year of 50,000. The adjusted weighted average annual income tax rate would be 24%. Quarterly income tax expenses are computed as follows. Next is an illustration for a statement of previously reported interim financial reports. The requirement is to compute for the restated profit after tax during the first quarter of year 2. Solution: profit after tax before adjustment of 100,000 cumulative effect of change in accounting policy of negative 10,000, loss on discontinued operation of negative 9,000. The restated profit after tax would be 81,000.
Examples of application of recognition of measurement principles. Number 4, use of estimates. Inventories. Halimbawa nito is yung paggamit ng gross profit method or yung retail method. Classifications of current and non-current assets and liabilities. Provisions, pensions, contingencies, revaluation and fair value accounting, intercompany reconciliation, and specialized industries.